Hi, Doug Jones here at Mortgage Magic and Doug Knows Real Estate. I've been lending a long time. And in my experience, almost everybody, every homeowner is always wanting and needing more money. And right now, it's not the time to refinance. So if you own your home already, you probably got a pretty good rate. It is not the time to take money out of a refinance. And I'm going to tell you, it's not the time to do an equity line either. And I'm going to tell you why, because equity lines can be pulled. And here's some things about equity lines most people do not know. As a matter of fact, few people know. Equity lines, and every one of them, you can look at your contract, every one of them have the potential of going to 18%. 18%. And they all have a closing fee of $500, and they're based on prime. Now, today, prime is 8.5. If the Feds raise the rates again, which they may do in the next month or two, that's going to go higher. It's going to go a quarter higher each time. And even though the prime is 8.5, most people are not going to get a prime rate equity line. They're going to get a prime plus margin. So if a margin is 2, they're going to get a prime plus 2. That's going to be 10.5. Well, a real problem of equity lines, though, is that I remember back in 2008, I remember one bank in Colorado closed something like 30,000 equity lines in one day. So people were getting equity lines, but they weren't pulling the cash out of the equity line. It was sitting there, and bingo, the bank just came in and closed them all. And banks can do that. And it even says, if you look at your contract, they can close them at any time if they suspect a financial downturn. So they can do that. So what I recommend instead, I don't recommend getting a refinance mortgage. I recommend getting an equity loan, a loan, because a loan is one, it's fixed rate. I have loans that are 20 and 30-year terms. There's no closing costs, and there's no balloon payment. So they're amortized, 20 or 30-year terms. You can pay them off anytime, and they're fixed rate loans. Now, some people could use an equity line because if they're not going to need the money and then they use the money and then they pay it off, that can work. But then again, they still have the risk of the equity line. But if you're in a situation where you need the cash, a lot of cash up front to pay things off, then you want to get a loan, not an equity line. And I want to give an example. I got a thing up here, drcalculator.com /calc /blended .html. That's a site you can go to and you can look at your cost of money, your real cost of money. Let me give you an example here. Let's say a person has a first mortgage of $486,000. Now that person wants to get $120,000. Well, if they do, then they've got a new rate loan of 606. The refinance rate is going to be at least 7.38, probably close to 8% by the time you see this. So if they refinance that, they're going to lose this rate and they're going to raise their total rate to about 7.38. But if they get a mortgage instead, a second mortgage, that second mortgage, now I use 9.5%. The rate is determined by credit score, and it's determined by loan to value. So the rate can be, but that is a good rate we had today, we have right now. So it could be 9%, it could be 10%, somewhere in that range, okay? But the point is it's going to be fixed rate, and if you put this in the calculator, put this balance, put this balance, put this rate, and you'll come up with a blended rate, and the blended rate, the real cost of all the money is 4.087. So that's a lot better than 7%. So 3% a year on 600,000, that's $18,000 savings right there. So that's a big savings. So what I'm recommending is get the money you need, get the money you want to use, but get it in a second mortgage loan, an equity loan, not an equity line, and don't consider refinancing at this time. So I'll be glad to help you because I have this loan. I love the loan. It helps a lot of people. I'm Doug Jones at Mortgage Magic, and Doug Knows Real Estate.